When governments talk about higher tax collections, the first question is simple. Did taxes go up or did the economy grow? The answer often lies in one number, tax buoyancy. Tax buoyancy measures how fast tax revenues grew compared to the economy. If tax buoyancy is above 1, tax revenues are rising faster than GDP. If it is at 1, taxes are growing in line with GDP. And if it is below 1, tax revenues are lagging behind economic growth. Now let's look at the trend. In FY19, tax revenue grew 13.46%, while nominal GDP grew 10.46%. Tax buoyancy stood at 1.29. In FY20, tax revenue fell 7.65%. Even though nominal GDP grew 6.29%, tax buoyancy turned negative at minus 1.21. This was largely because of the corporate tax rate cut from 30% to 22%, a deliberate trade-off aimed at supporting longer-term investment. Then came FY21, the COVID year. Both nominal GDP and tax revenues fell, which is why tax buoyancy was not computed for that year. Now watch what happens in FY22. Tax revenue jumped 49.12%, while nominal GDP grew 19.34%. Tax buoyancy surged to 2.54, the highest in this period. This reflects a strong rebound year where collections rose far faster than the economy. After that, buoyancy stayed comfortably above 1. It stood at 1.27 in FY23, 1.48 in FY24 and 1.39 in FY25. In other words, tax revenues consistently grew faster than nominal GDP. Now look at the FY26 budget estimate. Tax revenue growth is projected at 10.8%, while nominal GDP growth is projected at 10.1%. That puts estimated tax buoyancy at 1.07, lower than recent years but still above 1. So here's what this chart tells us. When tax buoyancy stays above 1, the government can raise more revenue without relying heavily on new tax hikes. Growth expands the tax base, compliance improves, and collections rise more naturally. That is why going into Budget 2026, economic growth matters more than new taxes, because when the economy grows, tax revenues usually follow.